If you're trying to better understand insurances or try to get to understand your own current insurance through your employer, whether it's Medicare, individual, healthcare.gov, wherever it is, it can be very confusing because it's terminology you don't use every day. Let's break down some of those terms. Now, first off, really, you should understand the concept of what insurance actually is when it comes to health insurance. It's just a transfer of risk. No longer, if a medical disaster happened, is the risk on you. The risk is on the insurance company. And in order to get that transfer of risk, to have them take over that financial responsibility, you then have the first term, a premium, which is the monthly amount typically that you're paying to the insurance company, or if it's coming out of your paycheck, however you're paying it, that's the amount that you pay to have the right to have that insurance. Then when you start to use that insurance, you have things such as copays or coinsurances. A copay is a set dollar amount. Let's say a doctor's visits on paper costed $100 to visit that doctor, but your copay, the set dollar amount you had to pay, was only $20. Well, that's how much you're paying. Whereas a coinsurance is a percentage based off of what the total cost was. So if your doctor's visit was $200 and you pay a 20% coinsurance, you'd have to pay $40 for that doctor's visit then, in those simple terms. Now, there are different deductibles or limits sometimes involved. A deductible is a certain dollar amount you have to reach before insurance starts to kick in. For instance, a deductible of $1,000. You have to pay $1,000 in medical expenses before the insurance kicks in. Whereas a maximum out-of-pocket limit, or also you may hear one say MOOP, for instance, for short, that's the most financial risk you have when it comes to approved medical expenses. If you hit that max out-of-pocket, let's say it's $6,000, you pay $6,000 in copays, coinsurances, deductible throughout the entire year, then for approved expenses, it will cover 100% the rest of the year. Now, some other things to kind of keep in mind when it comes to insurance is also understanding the difference between an HMO and a PPO. An HMO, for short, is a health maintenance organization. This is where you have a primary care provider and you have to get referrals to see specialists from your primary care. Essentially, your primary care provider is acting like the quarterback, helping direct your medical care. The goal with an HMO is to be proactive and making sure you're taking care of preventative care. Whereas a PPO, a preferred provider organization, is where you don't have to have a primary care provider. You don't need a referral to see a specialist. Insurance doesn't require that. And you can also, if you decided to, you can go outside of their network of doctors. Now, what's the difference between in-network and out-of-network? Well, in-network is a doctor that's already approved the insurance and is willing to accept the terms and conditions of that insurance company. Whereas if they're out-of-network, they haven't agreed to those terms and conditions. So if you do want care out-of-network to a doctor that doesn't currently accept insurance, they do have to accept those terms and conditions. Now, typically out-of-network, you pay a little bit more because they're going to pay that doctor more because they aren't willing to accept a lower rate. Now, one thing that's a misconception doesn't mean that you could just technically go to any doctor. The doctor still has to accept your PPO insurance if they're out-of-network. There's no guarantee that they will accept. Then lastly, the one other term to keep in mind is that you may hear frequently is prior authorization. What prior authorization is some of these companies, depending on your plan, may have prior authorization for certain procedures. And let's use an MRI, for example, because MRIs typically can be pretty expensive. So the insurance company may want you to have it pre-authorized or have a doctor's note basically stating why it's a medical necessity to get that use that MRI before they go ahead and cover it. Their goal is to, one, make sure that you aren't just frivolously getting care that's not fully necessary. That may cost you and the insurance company more money over the long term because then rates start to go up and you start to use care that you aren't really needing to use. Those are some terms that will hopefully help you better understand the terminology that you're seeing when you're looking at the paperwork for your current health insurance, or if you're shopping around looking at those different things, so that way you can be a better informed consumer. The most beneficial thing you can do for yourself when it comes to health insurance is educate yourself.